Hey traders, Nick Shaheen here looking at Moderna. I just got a question. What do you think of Moderna from the chat room? And I'm thinking to myself, all right, so to be honest, if I'm not long the stock, I'm not going to chase it. I should be man enough to say, I missed it. I'll catch it on the flip side. That doesn't mean I go out and short it. So I use a silly acronym for something like this, THTH. It's too high for me to chase it and too hot for me to short it. So if I have shares, I would probably have sold already covered calls against them somewhere. If you don't know what that is, look it up. It's a way of almost like creating your own dividends if you know what you're doing. But before I sell a covered call, I must be honest with myself that I am okay selling those shares at that price. I say this because probably 80% of the people that do it come back to me and say, "Oh my God, I'm losing money." It's like, no, the worst case scenario is profits. So it's you weren't honest with yourself in the beginning. So anyway, let's see if I can update the chart. I haven't looked at it in a little bit, so I assume my drawings are old. Sure enough, I don't need this box right now. So this was the most important line. Once they broke out from it, they did it in a big way. Even better, they came back, tested it for footing, and then launched. Repeat the process over here, repeat the process over here, and then to the moon. I think this was, I don't know where they got the announcement of the inclusion in the index. So you can do that yourself. So as far as where would I buy a dip? Boy, it has a lot of dips in order for me to even consider it for myself. From a chart perspective, nothing to do with the sales and all of that. Just from a chart perspective, for me, I wouldn't want to touch it until at least comes down to 260 or lower. In fact, the only place I would be like in with conviction, somewhere around 215. Don't get insulted by it if you're long it. I'm just telling you where I would get engaged. Looking at the fundamentals, it's hard to use them intelligently because it's new, right? They worked so hard to get a product out. They got it out in time. They beat everybody to the punch from the new guys, and that's outstanding. So they're reaping the reward right now. Like somebody like Novavax, what the heck are you waiting for, right? So look at that, 3 billion in revenues. That's legitimate. But remember, this is a pandemic. Is it going to be repeating? I don't know. So that's the question mark. That's why I say I can't use the fundamentals. They're great right now, but that's an unusual year. It's like a honeymoon period. So I will sideline the fundamental conversation until I see at least another year or another quarter or 2 quarters to see patterns. That's why I would be conservative. So there are ways I can do this using the options markets, and the easier way to see it is just to go into the options market and see what's available. So instead of buying shares, if somebody's looking to buy shares right now, why not sell a put instead? What put? You're going to short it? No, sell a put. So somebody that wants to short the stock would buy a put, or somebody that wants insurance to, they would buy a put. So here's the definition of that, how that works. If somebody is long from way lower and they want to guarantee themselves an out at 240, and you say, hey, I wish I had bought it at 240, then it's a symbiotic relationship. They buy a put, it's green, you sell the put. So I'm not recommending anybody do this because it's not easy work, right? I only sell a put if I want to own it. So if I want to own it, let's say I missed it at 240, I just said I would get engaged at 220. So I can pre-set my price by selling that put, and effectively what happens is the person who buys the insurance from me gives me money. So no money out of pocket, and I'm already long Moderna. Worst case scenario is I buy Moderna at 220. That is me selling the put. Do I have a choice of changing my mind? No. The only way I can change my mind if price starts falling is by actually booking the loss. Meanwhile, let's say it falls 10-20%. Let's say it falls to 230. This $2 is going to show me I'm down 1,000% or whatever. I don't care. What? I don't care. My goal was to own it as 220. So the worst case scenario, I wake up one day on Monday and I own 100 shares at 220. That's it. My break-even point is at 217 and change, 217.4. So I wake up owning the shares. If it's above 217.4, I can decide, you know what, I changed my mind, I'll sell the shares. So what happened to that 1,000% loss? Nothing. It just goes poof. As soon as they give me shares, they take the put with them. So if I don't panic and buy back the position I sold, I'm good to go. That's where the problem happens. People sell the put, not really intending to buy the shares. Therefore, it turns into 1,500. They collected 300, and suddenly now they're down 1,300 or 1,200 per contract. That's a disaster. Meanwhile, if they had just sat patiently, taken the shares, they'd be green, even, or a little bit down. Anyway, that is the proper way of using options. That's a safer way. You're still not convinced? So consider somebody buying the shares now. They're down from 310 to 217, where I break even. So if they buy the shares, you're saying it's safer than selling a put. You tell me how that works out. If you buy the shares here, you're out the money out of pocket. You need a rally to win. If I sell a put here, no money out of pocket. Money comes into my account. I don't need a rally to win. Rallies, I win. Doesn't rally, I win. Falls, I win. The only way I lose if it crashes to 217 or lower. So let's say it does that. Crashes to 217 or lower. You say, there, I told you it's not safe. Well, if you bought the shares, you're already down from 310 to 217. That's actual losses for you, whereas me, I break even at 217 if I sold it. So again, I'm not recommending this trade. I'm making visual example, real life example to illustrate, demystify options a little bit. Moderna, good company. So this would be the place where if I would change this one to say, okay, I would buy the dip down here for sure. I could repeat that, do that process higher for somebody that wants it around 240, because that would be also like a visual place. Actually here, better, closer to here. I'll split the difference. I'll put it in the middle. Look, it failed here. They took their time to break out. They tested it for footing. So anywhere here, 216. Wow, how weird is that? We just came out to that value. 215, the break-even point. Yeah, that'd be good. So if you bought it here, you'd be down. Come on. Oh my gosh. 25%, 30%, whereas if somebody sells the put, they'll just be breaking even. A visual reference as to what happens. So this is definitely, this orange line, by the way, you should pay attention to it. You're saying it's 150. Well, if you don't pay attention to it, that's where most of the trades happen. So you see these big giant volume bar right here, right? And a big giant volume bar right here, right? So all of these volume bars, they tell me pretty much nothing. They just say when something happened. It's not very useful. To me, I want to know at what level they happened. And this orange line is mathematically drawn that says this is where most of the trading happened for the last year by far. Look at it, the peak, that bar right there. And then the second two most busy bars around it, and then the other around it. So it has not had time to mature up here. So this is froth, not value. Trading froth, meaning there's not enough history for machines to look for. So on a bad day for the market, they would struggle to find conviction buys. They need to mature. Look at the volume. That's where they're interested. So if it crashes into here, it's almost a blind buy because of all of this. This is another study if you want. There, second lesson. I don't have many studies here. Everything is hand-drawn. This is one of them. Volume profile. Study it. And this one on TradingView is pretty good because it adjusts. If I zoom in, it changes the time frame. So if I zoom in to really short term, then you start seeing more action up here relative to down here. You see these faded ones? If I see now, it's almost even. Anyway, here. See how there's more relative to here. Even at this level from May to now, this is the busiest point. How did I pick this? Like back to do that 220 number. So I visually picked it, and now we zoomed in, and it comes up as I don't draw this orange line. It just adjusts it automatically. So solid look on the stock. Good stock, too high for me to chase. I would buy the dip. I just showed you how I can, quote, buy the dip ahead of time, provided I'm okay seeing paper losses, because if it falls, there's going to be tremendous paper losses if I sell a put now. I'm not inclined to do anything with it right now. I'll sit on my hands and sell a put on a bad day. Like if you did it in Netflix today, you collected a heck more premium than if you didn't done it yesterday. Not from the drop, because the put options are the implied volatility is nervous and just exploded. Do it on a bad day for the market, like VIX high, it's falling, implied volatility for it is falling. Wow, that would be huge premiums. That $2 that we looked at, $3 would be like 5, 6. Nick signing out.